So you're ready to do your first development, or you're ready to do your 10th development. How do you choose major bank, non-bank, private funder? What are the pros and cons of all of these different lenders, and how do they come together? Stay tuned to find out more. There's no one solution depending on the project. Sometimes we need major banks, sometimes we need non-banks, and sometimes even private. The way that we break it down is into stages. So what stage at your project are you at the moment? Have you acquired the site? Do you have DA? You're ready to start construction? When we're looking at a site, the first thing that we should be thinking about is the acquisition finance and the time to get the site construction ready and the funding required to get it to that stage. Now, the reason that that is important, I've seen many developments fall over that were good developments that originally would have worked by starting with debt that is too expensive when they should have been looking at debt through majors or non-banks that is a lot cheaper. When we're looking at acquiring land or multiple properties, we want to make sure that our cost of debt is the lowest it can be. We also want to make sure that when we're initially buying the property, that we're minimising the amount of cash that we need to use and that we can park that additional money somewhere that it's liquid so we can use it for our professional costs and all of the other things that we need to pay before we're construction ready. So what we'd normally do, let's say you've found multiple sites, this can work at any scale. Multiple houses, we want to buy all of them, and we're going to do a large-scale apartment development. The first place we want to look is standard residential loans through standard lenders. So that can be majors, that can be second tiers, that can be non-banks. Anyone that offers a 30-year mortgage, generally interest only with an offset account. Now, most construction we do through trusts or companies, so we need to ensure that they'll lend to an entity like that as well. Now, when we're looking to do the development, if you're looking to use property that's in your personal name or maybe a different entity to help support the project, we normally want to go to a standard mortgage lender and get that equity out first, if we can, rather than provide that security to the new lender and clump it in as part of the new development. Some of the advantages of doing that is we have liquid capital available that is uncontrolled and we can use it how we see fit. Until we use that money, we can park it in the offset account against the facility that we originally drew it out from to ensure that we're not paying additional interest on top of what we need to. And we have a lot more control. We're no longer at the mercy of the lender and what they're willing to lend. And we have choice of lender, because if the asset that you currently hold that you may want to provide a supporting security is capped from an LVR perspective, maybe due to location, maybe due to the type of asset by the lender that we'd be looking to go to, would rather get the cash out, and that way we've locked in that money and we can use it. So let's say you found the site, you've accessed equity externally, we've put that equity into the entity and we're now going to purchase the site for the development. So we're looking at generally a standard residential mortgage. We have multiple different options of verification with the full documentation, the alternate documentation and different methods there. But we just want to focus on getting the lowest cost finance initially. That's going to reduce the cost in the feasibility. And if it takes us 2 years to get DA ready, then at least in the event that we're waiting for that to come through, everything else is low cost, it's taking care of itself. If it's existing property that we're going to demolish, it may also be rented, further reducing our holding costs. We're now ready to start looking at construction finance. What do we do? Now, major banks, they don't really play in the development space unless it's a smaller scale development and it fits into that residential sphere. If we can service the debt, then banks are a good way to go. Banks also may require a certain level of pre-sales for your development. And in the event that we don't want to take a hit on the final sale price by selling them off the plan, we may need to look at non-bank or even private lenders. If our project has a significant amount of equity, or will finish with a significant amount of equity, then we can look at certain non-bank lenders who offer development facilities that don't require us to determine a level of serviceability. So what that means is that we're looking at the feasibility of the project, we're looking to fund a certain percentage of total development cost, so normally up to 80% of your TDC, and the LVRs need to fit within certain margins depending on the type of security that we're constructing. Now, in the event that we're not super strong on the equity, or we don't want to work with one of the non-bank lenders, who can be a lot slower in some cases, that's when we can look at private debt. Now, private debt's a lot more flexible in the development space. Some lenders are a lot more geared towards construction than others, and that's why it's important to engage a broker rather than talking directly to these private lenders. What you need to make sure is if they're giving you money, are they giving you money for you to finish the project, or are they giving you money to push you into default for them to finish the project? Now, I know that sounds dark, but a lot of lenders may not fully understand your project or how the debt needs to be structured. What that can lead to is missing potentially a progress payment point, going over the originally set loan term for the facility, or just not meeting some of the other covenants on the facility. What that may push you into is default, and there the lender takes back the site and they may complete the development or charge you default interest, therefore increasing their profit margins. So we have to be very careful when we're choosing a lender for construction. We have multiple lenders that we've worked with previously that all focus in the construction and development space, and we can be a little bit creative. What I mean by creative is we don't always have to look at just funding the project with a fixed price building contract and it's very rigid and very structured. Like if you've ever built a property through a bank, you understand you have to have the fixed price contract and we're paying as per the percentages. With private finance, we can be a lot more flexible. So we can adjust the percentages and we can align the progress payments to the stages that you'll meet and stages that can be met without needing significant external funding in between stages. Because what we effectively need to control is the flow of funding throughout the development, and we don't want that to stall because then we can sit there with the development accruing interest, partially completed, and therefore our feasibility is reducing in terms of the amount of profit that we'll have available. Pros and cons of all of the different lenders. Major banks, they're probably going to be the cheapest. They're also going to be the slowest. They may also be the hardest to deal with on larger developments, unless the development has a lot of equity and has some pre-sales. In the event that we're looking at something maybe less than 10 to 15 mil, then we're most likely looking at non-bank lenders. Now, just quickly reverting to the majors, if we're doing a duplex or something smaller, rooming house, we can normally use the majors without too much drama. If we're looking at something bigger, townhouses for example, then we need to move into the non-bank space. Now with the non-banks, we're starting to look at development facilities. That's still going to take a while to get approved. Progress payments may take 7 to 14 days, depending on who we're dealing with and where we're up to. We might need to get a QS report. The valuation we need to hope comes in okay, because if it doesn't, we don't have too many other options there. And all of that needs to stack up. They're still cheaper in some instances than the private debt, but they have less flexibility. Now, private debt, whether it's senior debt, which is generally up to 60 to 70% LVR, mezzanine debt, which is generally slightly above that, normally up to 75 to 80. So that might be a second or third mortgage. And then we have preferred equity, which is where we're getting money in and we're sharing equity in the development with somebody else. Whatever type of private financing we take, it's generally faster and more flexible. It is more expensive, but it does have more risks. So normally when we assess a development, we've got an internal tool where we look at your feasibility and we look at whether it fits in major, non-bank or private. If it fits into private, then we obtain multiple quotes from lenders that have worked in the space before and are ready to facilitate construction at the level that you require it. And then we'll put together a proposal that we can present back to you. Now, the way it works across all of these different lenders, especially for development finance, is we initially have to review the feasibility. And it's a very good idea for you to get a quantitative surveyor report up front. So that way we can check that all of the numbers in your feasibility make sense. Because when the lender looks at the feasibility, they're not just looking at whether your feasibility stacks up based on your numbers and your costs. They want to make sure that if you were to default and something was to go wrong and they took over the site, are their costs going to be the same? So for example, if you're getting concrete trucks or something else very cheap because you know somebody, or maybe cranes or something similar are rented from a friend and they're at a heavy discount, which boosts your profitability and the feasibility, when the bank and the QS review it, they're going to put that at market value. And what that effectively means is we're going to know exactly what it's going to cost for you to build the property in the event that the lender couldn't obtain the same discounts. And we want to make sure that we're basing our feasibility off that figure in the QS rather than your figure if your figure is lower. We want to ensure that we're setting our development up for success and we're presenting it in the best possible light to get the lowest interest rates and lowest fees and the optimal term for our debt structure. When we're looking at terms for development finance, we're normally looking at the period that it's going to take for you to build, plus overruns. Then if you're selling the property, generally a sell down period. Some lenders may just give you the development finance, and then they'll roll you into what's known as a retained stock loan for that remaining period of time. Retained stock loan is essentially where development is finished, you haven't yet sold all of the units, and it's just a basic investment term loan with a private lender that hangs onto those properties at a high rate of interest until you sell the properties. So we want to try and sell them nice and quickly and be marketing through the development campaign or marketing through developing with a good campaign, and that way everything should come together.